Joining us now to share his commentary on the day's market performance is Cobus Potgieter from Southern Cross Capital. Cobus, thanks so much for your time this afternoon. So we are seeing, some red screens coming through over in Europe, in Asia, and here at home. What's going on? Is it just some profit taking, especially after, the record highs we saw out in the US and here at home as well?
The big 100,000.
Yes.
Yes. Yeah, you've hit the nail on the head. All the top performing stocks over the last week, and let's be honest, it's been a fantastic 7 months overall, a great July, and the same sector that has outperformed and was up in excess of 10%, down around 2% today. So it's profit taking. I think the market feels perhaps a tiny bit overbought. I dislike the technical term, but it's quite typical after such a sustained 7-day rally. The optimism certainly hasn't gone away, but it does feel like the market feels it's gotten ahead of itself. And before the weekend, let's take some risk off in case we get some adverse news.
And with that in play, while we have that optimism playing out, we also have those earnings out of the US and Europe. And I want to touch on LVMH's numbers, posting lower quarterly sales. Interestingly, the group plans to open a second factory in Texas as we await that US-EU deal to be sealed. What have you made of that move?
Well, it's a clever move. And I think, it's been very difficult to take a positive view on the tariff war. The net negative is real, but part of what the pro-tariff faction or the isolationist faction has been selling is this idea of a reflation through investment, essentially forcing these manufacturers to open factories to provide jobs. Obviously, the real reason for job loss, manufacturing job loss in the US, is automation. It's not offshoring, as the government often claims. So from that perspective, it won't really lead to significantly improved employment in that sector, but it certainly does lead to some investment from those players that concede to this pressure and accept the reality of needing to onshore some of their production to remain, to maintain their access to those markets. So from that perspective, that looks like, at the very least, a political win for the pro-tariff faction within the Republican Party.
And just talking about investment, even earlier this week, I think it was AstraZeneca that announced plans to invest about $50 billion into the US. So, I guess a win for Trump and his fraction. Let's move over to some local company news. That bidding war really heating up, and it seems like Hyprop is sitting this one out and saying, listen, we are walking away from the bid to acquire Mass, that is. Did you expect this? I mean, Prime Capital and Hyprop really seem to be at odds.
Yes. Look, I find it very rich that Prime Capital are accusing Hyprop of corporate bullying, given that is precisely the reason this white knight was required in the first place. And I must say, compliments to your colleagues. Business Day have done a fantastic job in trying to uncover and shine a light on what is allegedly occurring with the creeping share ownership and what seems to be unfair dealing between Prime Capital and Mass. So essentially that, Prime Capital control the board of Mass. One of the founders, literally a spouse of one of the founders, was until very recently appointed as the CFO at Mass. And frankly, given that the major underlying asset and the distressed asset inside of Mass is this joint venture with Prime Capital, there is no way I would have a look at I would purchase this, as a responsible custodian of shareholder capital. management of Hyprop without having access to all of this information, seeing what kind of leverage Prime have over Mass, because ultimately you will assume as the new owner those obligations. I'm not certain this is over. They've essentially withdrawn because they say it's unlikely that they'll get this information, but they are alluding to the fact that they expect the JSE to force Prime and Mass to provide this information. So I don't think this is over. And of course, we know the institutional shareholders were supportive of the Hyprop deal and hoping for more transparency and hoping for ultimately a better outcome for minorities, because it seems like we've got a big shareholder bullying the minorities. So this certainly isn't over, but it's sort of a step in the wrong direction, Hyprop backing away from the transaction.
Yeah, and that was going to be my next question. What happens next? So we're just, I guess, waiting for the JSE to get involved.
Yes, waiting for the JSE to get involved. And I mean, barring that, accepting Prime Capital's deal. And, I mean, my recommendation as an investor would be to never accept that deal. Essentially, a tiny cash stipend followed by a preference share with dubious liquidity and dubious counterparty, where I've essentially got to loan you the money to buy my share and assume all of that risk. That makes absolutely no sense. So I'm not interested in Mass or the offer on the table from Prime Capital.
All right, let's move over to Cash Build. They're out with an operational update. We're seeing an increase in the top line, and that mainly being boosted by sales from its SA stores. Just your analysis on that fourth quarter update.
A little boring, but not terrible compared to some of the updates we've been seeing. I think what's somewhat frustrating is they don't seem to have been able to push through significant price increases or inflation in the business. That's around 1.7%, which does mean that the growth is real in terms of units being sold. But yes, the business has sort of languished, gone from a darling to a little bit sideways, and adding a net 4 stores for the period, after subtracting the stores that they've closed as well. Not the growth story it used to be. That being said, the valuation is undemanding. I think one of the reasons it doesn't get a lot of love is the float is so tiny, and the liquidity in the share itself is quite poor.
All right, let's hit pause on the conversation, Cobus. Before we move on to your stock pick, let's take a moment to touch on what other industry players find interesting.
Google, of all things. No, not of all things. I mean, after their results, and specifically if I take a look at their returning revenue growth this quarter, which I think was the highest ever, and considering their valuation versus their peers in the sectors, the Meta, the Microsoft, Google is cheap. I think it has catch up to do. It's on its way to retesting its previous high at a few months ago. It's just an absolute behemoth in not necessarily advertising, which obviously is as big as mainstream, but as far as their development AI is concerned, it's going to be difficult for us to compete with the type of expansion they're doing, the type of skill they've got, and the kind of results that they are showing at the moment.
I'd say the JSE itself, JSE Limited, we celebrated 100,000, was it yesterday or the day before? And that just shows you how much activity has grown, both in bonds, in derivatives, and in equities. And I think for as long as markets remain this volatile, it's the exchange that actually makes money. It's very well run. They've buttoned down their operations to a T. So as activity grows, you should see a bit of operating leverage because of excess capacity, and that should reflect in the share price over time. So I think it's an attractive entry point. I think it's a solid business, and I think it's one investors should look at more closely.
So JSE Limited and Alphabet, your take on those counters?
I like both. Look, in the wake of those Google results, there was a bit of pressure on the stock, and it seems like it was mostly related to the massively increased capital expenditure bill, because obviously the revenue numbers were phenomenal. Record highs, and subsequent to that, the CEO has sort of released a statement indicating that we are forced to do all of this capex because of the unprecedented demand for our AI products, and ultimately, that's the reason we're having to invest into the pipeline. Google's somewhat a victim of its own success because they are the best positioned to deliver actual AI products to the market, so they don't maybe get the same fictional valuations as some of the other cutting edge players, but they are particularly well positioned, and it has been a laggard in that space. I like it, and I believe it should play a bit of catch up relative to those other names, the likes of Microsoft amongst others. JSE, yes, absolutely. I think they've been a massive beneficiary of the robustness in precious metals and mining locally, and of course increased interest in South African bonds. So we've seen the foreign ownership finally tick up. A lot of this activity really wasn't really being driven by offshore volume, and those tend to be sort of the marginal trading liquidity providers in our market. That is ticking up. There's clearly a lot of interest. I think all emerging market bonds and South African bonds in particular are still looking relatively more attractive, given that we don't have these inflationary increases in defense spending, and other pressures that we're seeing in the likes of Europe and the USA. So from that perspective, that demand should continue to grow. Emerging market equity still looks particularly attractive, and all of this just means volume for the JSE. So from that perspective, it is a bit better managed. You used to score a lot of own goals, but lately it's been executing much better. I can't remember the last time the JSE had downtime. When I started my career 15 years ago, there used to be downtime once or twice a month. So the execution's certainly better, and I think the environment remains accommodative. And the valuation is very, very much undemanding still, despite this high.
So you like both the counters, but neither are your stock pick. Where are you hanging your hat today, Cobus?
So my stock pick is going to involve a lot of Google.
Okay.
It's just that given I did a bit of a half-year review and realized that in rand terms especially, the JSE has been on an absolute tear. And for a South African investor, they've made a lot more money in local equities over the last, and frankly local bonds, over the last year than in their offshore holdings. MSCI World is underperformed, largely because of dollar weakness, rand strength, and of course relative outperformance in the equity markets. And I think we perhaps now is a good time to diversify away from the South African assets, assuming you've had the dislocation in your portfolio. And that's why my recommendation is XTX WDM. That's the Satrix MSCI World, which essentially is mostly developed markets. You're going to get exposure to the Magnificent Seven, amongst others. Google as a large percentage of that basket, and a lot of other diversified basket of developed market equities. I think now is a good entry point to maybe sell some of those excellent South African holdings and move some of that money offshore.
Some profit taking, that's what we are actually seeing on the JSE today. Cobus, thanks so much for your time and taking us through trade this afternoon. That was Cobus Potgieter from Southern Cross Capital.